Hey guys, what's going on, and welcome back to another video. My name is Dion, and today is the day we begin the Funded Trader Challenge. Since this is the start of the challenge, I want to open up with an analysis, a breakdown, a thesis, my opinions and thoughts on pretty much what the market is doing from from another point of view, other than just the technicals. So today I want to break down simply the fundamentals, the technicals, and the on-chain analysis for Bitcoin. This is primarily what I will be trading, so this is where I want to keep most of my focus, and this is, sort of where I want a tunnel vision. So I can just rely on technicals if I want, but I feel like if I want to take this seriously and trade the best that I can, I need to consider all factors, which also includes the fundamental analysis and the on-chain analysis. So we'll start off with the macro sentiment of the fundamentals. Pretty much what kind of environment are we in at the moment, and how can this affect BTC price action? So BTC is like the biggest cryptocurrency, and the cryptocurrency market is highly correlated, and it is affected by the rest of the financial market, so like stocks and all this and that. So this is something which we're going to have to consider. So what kind of environment is the rest of the financial market in? Right now, we're experiencing quantitative tightening, which essentially means that, this is how I'm going to choose to word it, the government is trying to slow things down a bit, right? So during COVID, they had pumped lots of money into the system. Interest rates were lowered, which means it's more money is easily accessible to your average Joe. They can take out loans from the bank and not have to pay as much interest. This means that people will be borrowing more money, and if people have more money, they're going to spend more money, and it's just better for the entire environment, right? Not the environment, but you know what I'm saying. So pretty much everything's good. There's money in the system, money's flowing, people are buying, people are earning money, people are hiring. It's good. But inflation and this and that, they printed too much, and now they're trying to reduce that amount. So this is what quantitative tightening is. So interest rates are they're increased. And if interest rates have increased, it means that it is harder, or it costs more for the average person to try and take out a loan. So less people will be taking out loans. Things are more expensive. The market is trying to pull money and liquidity away. Oh, so the Fed is trying to pull money and liquidity away from the markets. They're trying to slow things down. And this creates a risk-off environment. So this is typically when investors start pulling their money away from, say, stocks, crypto, this and that, and they start trying to be more safe with their investments. So either this be like gold or real estate. Not too familiar with how real estate comes into play, but from my understanding, in a risk-off environment, they're not looking to be invested in risky assets such as stocks or crypto. So my entire fundamental macro view is bearish. I do see things continuing to come down, especially if they're going to keep pumping up the interest rates, which is what is expected. I just don't see this working well in the short to medium term. I do think that we do have further downside, not just in the crypto market, but across the market as a whole. Now, that's my fundamental macro view. So now let's talk about on-chain analysis. What is actually happening on-chain with BTC? So I've got a few metrics listed, which I'm going to go through, and I'll also put it up on the screen so you can see sort of what I'm looking at. So the first thing which I want to look at is the accumulation trend score. So as you can see on the screen, we have this little graph, and we have dark and light colors. The darker the color, it means that the more accumulation we're seeing. You can actually see here, it's going to describe whatever we're seeing here on the right. I'm not going to go into it, but I'm just going to give you my thoughts on it. So you can see here, when was this? April, well, 2019. Just before 2020, around this area, it's very dark, right? This is where most of the accumulation was happening. And then after that, we saw prices make their way up. We could see that in the massive bull run, which we got to see at the start of 2021, end of 2020. We were seeing lots of accumulation into these highs. We've come down. So what's the question at the moment? Where's the bottom, right? That's what everyone wants to know. The dip. Where does the dip? Where's the bottom? How can we catch the bottom? Well, let's have a look, right? Because for a bottom to be formed, you would like to see heavy accumulation before that happens. But right now, what we can see is that there is not, like, we are at this slight area of support, which we saw at 17,600. That's where we saw the wick into BTC. If that was going to be a bottom or a strong support, we would need other metrics to sort of like confirm this with us. Right now, in this area, we're not seeing heavy accumulation. So this suggests to me that there is further room for downside according to this metric. Now, the next one is the bear market floor models. So here they have a list of metrics which represent, whatever they have listed. The two main ones which I was looking at in this one is the 200 week moving average and the Maya multiple of 6. So this represents price trading at a 40% discount to the 200-day moving average. So say 200 moving day average is X. If price is trading at a 40% discount to that, so lower than the 200-day average, then this is what we're going to see. It's the red line. And the 200 week moving average, which is the blue line, it does say here that price has only been at or below this phase for 1% of the total days. So what that says is, statistically speaking, that price does not like to spend time below this moving average. And same thing with this one. 3.4% of the trading days closed at or below this level. So let's have a look at what's happening at the moment. We can see we have charts from pretty much the beginning of the year to current times, and price is below the 200-day moving average, and it is below the Maya multiple of 0.6. So what is this telling us, right? So it's giving us a clue, it's giving us a hint. If price doesn't like to be below these two metrics, and every time that we were below these metrics, price had come up and rallied from there, this is suggesting something. It is suggesting that this isn't in an area that price doesn't like to be in. Now, just because it bounced out of these areas previously, it does not mean that price will have to do this again, right? Because history doesn't repeat, but it often rhymes. That's the quote that people like to use. So when I'm looking at this, what I like to think, and what I'm currently thinking, is that, okay, we have broken below, but we have not come back and closed above. So I'm not seeing any sort of rebound. And given the overall fundamental, the macro view, which is telling me there is room for further downside, more than likely we have broken below these levels, but we may find price below these levels for X amount of time, because I do believe that it is going to be boring sideways ranging action over the next couple months at least. Okay, so now we're going to be looking at the reserve risk. So what does this mean? If price, the closer price is to, or if it's within the green zone, essentially what that means is that the hodler's conviction is high. You can actually see it here. So the reserve risk. When the reserve risk is low, the hodler conviction is high, which is within these areas. So you can see that we have the reserve risk as a orange chart here. And then above, we actually have the spot price. So here we have the two zones. We have the we have the low reserve risk, and we have the high reserve risk. So when I'm looking at these two areas, what matters to me is the orange line, because this is how reserve risk is plotted on the chart. So when the orange line is within the red area, it means that the hodler's confidence is very low, or their conviction is low. As you can see, when we did make these spikes into the red area, afterwards we did see a decrease in price, which would eventually take us to the green zone, which is where the reserve risk is low, which means the hodler conviction is high. And you can see here, it's a very clear pattern that price does tend to stay within the lower end of the reserve risks, stays in there for a longer period of time when we are there. So for example, have a look at the red zones, so the high reserve risk. When we did go in there, we came back down fairly quickly. Every time it spiked in, it spiked out. That happened multiple times just across this area. And have a look at how it affected price action. So when we did hit into these areas, look what happened. When reserve risk came back down out of the red area, we saw price falling and falling. And then it made its way into the green area, which is the low reserve risk, which means the conviction of these hodlers is high. And price typically likes to make its way back up from there. So currently, well, we don't have enough data to see, but price is on its way into the green zone, but it has not hit the green zone yet. We are not in this low reserve risk level. So what this is telling me that if we were to see price, if we were to see the hodlers pick up in conviction, we're not there yet. We still need to see price make its way down further before we are in this low reserve risk area. And the last metric which I want to talk about is called the percentage supply and profit. What this is going to tell us is pretty much what percent of holders are currently in profit. So you can see it's mapped out on the chart. You can see on the black line is the actual price of BTC, and in the orange, this is the percent supply and profit. So obviously, the higher percent of people that are in profit, I mean, look, the name speaks for itself. A higher percentage supply and profit just means more people who are holding BTC are in profit. Now, where did we find the lows? Like in relation to the percentage supply and profit. So you have this green area here, which is roughly at the 50% mark. So you can even see it here, roughly 40 to 45% in supply, percentage supply and profit, which means more people are in a loss than people in profit. That's when we see typically the bottoms form. So let's look over here. This is in like 2012. We had price come down below 50%, and then that is where we saw price like make its rally. We've seen price come down, and then from September, like late September to the next, so literally within the year, right? This would have been a very boring year, but price had come into this area. This is where most people were in losses. That's where we were before price had made its way up, and so on and so on. But you can see we aren't currently there yet. We're roughly sitting at like percent supply and profit. Okay, it's not. It's roughly 70 something percent. So generally or typically the bottoms are formed within that 45 to 40% in profit, but we still have a far way to get there. So what this is telling me is that we do still have space, or we still do have like an area where price can continue down before we like hit into this area of the metric, which is the bottom, which it suggests. Now, say price was to get to roughly that 50, 40, 45% area of like percent supply and profit, where does that put price? We can see it here. I think it just says it here, about 17.6%. So I will bring you over to the charts in a sec. And what it tells us here, what we can see on the chart is this last capitulation, which we had, this very steep drop in price action. It did take us to 17,600, right? And according to this is where a possible bottom could be formed within this range of 17.6 to I think about 21.6. Yeah, here. So really, like if we do want to see a potential bottom being formed, then this is where we would need to see price according to that metric. So that's all I have for the on-chain analysis, and what it is telling me is that more than likely we still do have room for further downside. We haven't seen any signs of a clear bottom being formed just because we haven't reached the levels in those specific metrics. So now let's have a look at the technical analysis. So if we go over into the monthly, we can see the monthly closed just above the 2017 all-time high, which is a significant key level, to be honest. So it closed above, which is bullish, to be honest. But if we go now over into the new week, new month, we are currently sitting below the last highs, which isn't good. But we are in this range, and honestly, that's based on my analysis, that's all we are doing at the moment. Like, we are seeing lower lows and lower highs being formed on like the mid to high time frames. But it is just a boring range. We've seen price ranging around in this area now. We've just broken below, but the thing is, we're below 20k and above 17.6, and I do believe that this is a range that we will see for a little bit. Now, how does this translate into my trading? So since the macro, like the fundamental macro view for me is further downside, risk off environment, just bearish overall, I'm looking for downside. On-chain analysis suggests that we have not been given any clear reversal signals, and that we still do have some further downside before we can before we reach the areas which are of interest in regards to forming a bottom. We just haven't seen those levels yet, so price still potentially can be driven to the downside. And where would this go? So using the reserve risk, the percentage supply and profits metric, it does state that we do need to see price roughly within the 40 to 45% supply in profit range. For that, like if price was in those areas, it would reflect on the charts at roughly 17,600 and between that and 21,000. So we are in the range at the moment, but honestly, for my target, since we are following a bearish trend, I would like to see lower lows formed, which would mean that 17,600 will need to be broken. So I have decided to target 17,600 as my downside target. And any invalidations at the moment, like looking from like a larger point of view, will be roughly the 20,000 level. So just around here, which gives us a range here. So what am I looking for? You can see that I have set an alert here at the previous areas where I could see there was some sort of like supply, or like a resistance. So what I'm looking for is, I can see that volume is declining right over here. So generally, if we're making a move and we're declining in volume, it means that there's not enough volume behind that move to continue pushing it forward. So usually it fizzles out and then price has to come back up and find volume before making the next move. So I've seen this over the daily chart, and now I'm seeing this on the 4-hour as well. Since like within this range, price volume has just been dropping. It's been dropping, and look, it's not looking too interesting for me. So what I would like to see is price to come back up into this area. And look, that's where I want to sell from, to be honest. And depending on how price reacts to this zone, it will determine where I'm going to place my stops, my invalidations, so on and so forth. But right now, I would like to ideally have my stops set above the last wick, and I would like to target the next low. So this is a trade which I'm thinking about taking. It is a 1 to 11.3 risk to reward ratio. And honestly, I'm just going to be patient, wait this out. Another setup which we could potentially see is the break in the trend line, which is just over here. So everyone's going to do their trend lines differently. People are going to try and touch as many spots as they can on the charts. Some people want to keep it at like the lowest possible area, so that when we do see the break in that trend line, then there's just a clearer pathway. So what I mean by that is, if I was to move this up and make it touch more and more, just because we touch more and more of like the support points on the chart, if we break below the trend line, then we still have these wicks, which represent like areas of liquidity, which we may see price bounce or rally from. So if I would like to be safer, I would place this here. But look, you don't want to get too technical with like the lines and stuff, because that's all they are. They're just lines. I guess what's important is sort of the macro view, the on-chain analysis. And I mean, look, that's just how I'm deciding to sort of handle this situation. So what am I looking for? I would like to see price come up into this area of previous resistance. We could see it's pretty strong. I would like to see a rejection from this area, and then my trade will be invalidated by the last high created, and then targets down to 17,600. So this would be a pretty nice trade. I guess now it's just a matter of patience, waiting for it to play out. The price of the market doesn't always do what you want it to do, so I do need to keep my eye out for many possibilities of sort of like what could unravel. So this whole trend line thing, which I was about to go on a tangent on, would just be another opportunity. Like, what happens if price does not reach up this level, and what if it comes down here, consolidates, and then drops with a very high volume, like a high volume breakout In that case, then I would take the trade like this. I would short when I see that high volume breakout with my stops just above the last high or just above the trend line, because my trade idea will be invalidated by a break above the trend line or the last high being created. So those are the two trading sort of opportunities which I'm currently looking for. I'm not too keen on going into the smaller time frames to sort of get the perfect entries, just because I know from my personal experience that I don't trade well in a ranging market. I trade much better when I decide to take the breakout trade, or for example, if I was to see price pull into this area of liquidity, see that strong rejection, put my confluence together, volume, this and that. That's how I like to trade. So that's my entire breakdown for BTC from a fundamental analysis, from the on-chain analysis, from a technical analysis point of view. And those are the two trades which I'm thinking about taking. So I hope you enjoyed the video. I'm really looking forward to what the week has to offer. Really keen for taking the funded trader challenge. I do personally think that I will be able to pass it within 3 trades, just because the setups which I'm currently scouting just happen to be the high risk to reward sort of setups. So I am pretty confident in it. I'm just need to avoid sort of what I do worst. And what I do worst is trying to catch many high risk to reward setups in smaller time frames in areas of consolidation. I'm going to stay clear of that. Like, look, there's no rush. I have plenty time to achieve this. So at the moment, I am really just waiting for that perfect setup which lines up with my entire thesis on the market and so forth. And that's it. I hope you guys enjoyed the analysis. Leave a comment, like the video if you enjoyed it. Subscribe to stay up to date with how my trading challenge is going to go. But yeah, look, I'm thinking about either starting it today or starting it tomorrow. The only thing that's holding me back at the moment is that I don't see any clear opportunities which I'm ready to take right now. The market is still setting itself up. My setup has not actually presented itself yet. I have just an idea of like how I want to tackle any potential setups which we may see happen. But for now, honestly, it's just going to be a waiting game. We're going to wait, see how this plays out. And yeah, like, you know, let's get it. 6-figure trader. I feel like I'm going to do this in just a few trades. And yeah, I mean, that's all I have to say. So we'll leave it here. I'll catch you in next week's episode.